Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The world of fixed income investing has undergone a seismic shift in recent years. What was once considered a stable and fairly predictable part of an investor's portfolio is now an evolving landscape shaped by technological innovation, regulatory changes, and rising financial costs. But this new landscape presents new opportunities, especially for investors who embrace a more active, data-driven approach. Now, remember, this information in this episode is general in nature. It doesn't take into account your own circumstances. Always look for a financial advisor when making any investment decisions. Vimal Gor is head of fixed income and multi-asset at Ellerston Capital, which is working with Solar Capital. It's a great supporter of this podcast. Most of what I've just said a few moments ago is actually Vimal's words, which she used in a piece in the Fin Review. Vimal, welcome to Fear and Greed.
Hi, Sean. Thank you very much for having me today.
So in the piece you wrote in the Fin Review, you talked about how much the fixed income market has changed over the past 15 years, and you talk about the GFC as the start of that. What's the fundamental change in fixed income markets that many investors probably haven't thought enough about?
It all really does stem from the GFC, as you mentioned, and the outcome of the GFC was regulators around the world wanted to make the financial system more regulated and a safer place to be. And so there was a number of new initiatives that came on the back of the GFC and the market dislocations we saw at that time. And the largest one was around bank capital requirements and Basel III. And that fundamentally changed the biggest player in the market, which are the commercial investment banks and the way they operate. And that left lots of opportunity and caused many changes in the market. So if we just step back and say what actually happened is if you look at banks, investment banks, they primarily have two ways of making money. The first one is they ride the yield curve, and that's why they borrow short and then long. So they take deposits in, which are generally at call, and they lend that money out to other businesses like SMEs, or they lend it to people for mortgages, which are generally quite long term, and they ride the yield curve. And so they have a mismatch, and they have to provision against that, and that's a capital requirement. The second way that investment banks make money is they trade securities, whether they be bonds, equities, FX, any securities, and they make a bid offer spread on those securities. But by virtue of the fact that they're not able to run the same balance sheets, it means they're not able to warehouse risk the same way they used to do. So their ability to make markets is massively impaired. So you've seen banks go from effectively a warehousing facility, which provide a lot of benefit to the financial system, to a model that's more capital light and more transactional in nature. So it meant they've stepped back from a number of businesses. They've really stepped back from the lending business, and they've stepped back from a lot from the market making business. And that has enabled new entrants to come into the space, which have fundamentally changed the way that fixed income markets work.
Okay, and I'm paraphrasing you here, but because of the regulatory changes, they've actually had to step back because it's just not profitable enough. They're not earning as much money if they do some of these traditional things we think about them doing. Ironically, you could argue then that the post-GFC rules around capital on the banks hasn't necessarily made it a safer environment. It's made it and I don't want to say a less safe, perhaps a less transparent environment.
That's correct. So it's definitely made it much safer for the banks and the holders of banks, because their capital is much they have much less capital on the line or in risky ventures. But if you step back and look at the whole system, the financial system, I don't know if the systemic risk has been lessened, and you can argue the systemic risk is higher because you've taken some of the activities that sat traditionally within the banking system, which is regulated, and it's gone out to the shadow banking system, which is much lighter touch in terms of regulation.
And so you're talking, and we don't mean shadow banking in a negative sense. We're just saying sort of outside the banking system. So we're talking about things like private credit, private equity, those sorts of things, Wimmel?
Yeah, private equity, private credit, the growth in a lot of the hedge funds, new market making operations that turn up. So you've got many new entrants into the space who weren't. So now I'll just read on that. So now you've got many new entrants to the space who weren't really around pre the GFCs. You've got all of these companies like Citadel, Point 72, Jane Street, who are stepping in and acting as market makers and picking up significant market share.
Okay, so what's that mean? Let's bring this to the fixed income investors then. So we have all these new market makers who are raising capital. That's where we come into the fixed income investors looking to put their money in different places. So how has it changed, and what's it mean for be it an institutional, but even a high net worth fixed income investor?
Well, what it means is that the way the fixed income markets has changed fundamentally. It's much more akin to the way equity markets are now, and that's about much more the amount of data you can get. That because obviously the high frequency firms trade on algorithmic basis, generally using a lot of AI. That what they've done is they've disintermediated the space and pulled a lot of the alpha out. So one, the market maker firms, but two, the high frequency hedge funds and the pod shops who are much more prevalent in this space than they used to be, say, pre GFC. They've sucked a lot of the alpha that would traditionally accrue to the asset managers or the end clients. That's now being disintermediated. And you can see that through the profits of these organizations. And so the ability to put on trades that the way you would have done pre the GFC is much lessened because there's just less alpha going around because that's been taken away by some of these new entrants.
So, as an investor, how do I think about that then? Do I think about fixed income in a different way to the traditional sort of safety, 60-40, whatever you want to play?
Well, the fixed income can still maintain that role and still has a very strong role and a very relevant role within diversified portfolios or 60-40 portfolios. But the nature of the way you position with fixed income has to change to get that benefit. There's no longer about just having a fixed income fund that's generally in a benchmark, whether it be one of the global aggregate benchmarks or the composite benchmarks in Australia or the like. You can't just have one of those and then try to trade around it to generate alpha because the ability to add alpha onto those is much lessened. There's also a secondary impact that we can talk about in a minute about the financing costs, which is directly linked to the official interest rates that exist in the market. But generally, it means that when you're looking at putting on fixed income positions, you need to be very clear about and very specific about what you want that exposure to do for you. Is it about a return generating exposure? Is it to give you diversification? Is it give you downside protection? You can't just now buy a global government bond portfolio and have it provide all of those roles. You arguably need to disaggregate each of those components that you need and build them up from a different way of approaching it.
Yeah, so we'll get on to the rates, but just before we do that, the point there is that it's actually harder, in a sense, to be a fixed income investor now because you really need to know what's going on because actually what's underlying what you're buying is potentially far more diverse than it ever was before.
Correct. It's harder because there's many more entrants in the space. But that said, you can argue it's somewhat easier and there's a lot more data as
Yeah,
well.
yep, yep,
So
yep.
if you yeah, data gives you information, it gives you transparency, and therefore it increases your ability to generate alpha. So the more data you have, the better it is. But you obviously have to have the tools and the skills to be able to process that data and to glean information out of them.
Okay, so what we've been talking about has been the result of regulatory change. It is kind of not to do with the fact that interest rates have been so low for the last 15 years. I mean, that's kind of of course, they're related, but mostly this is about regulatory change and capital positions overlay the interest rate environment of the last 10, 15 years on that. How does that fit into it?
Yeah, so it goes hand in hand that yes, the regulatory change means that the way the market operates has morphed since the GFC, but part of the new entrants and the changes in the asset class exposures we're seeing, for example, the biggest one is the massive influx of money into private credit, is because of the low interest rates that are around for so many years. When you're able to generate, call it 10 to 12% out of private credit, your interest rate was zero for many, many years. It was very compelling. But now interest rates are, call it 4 to 5, and your private credit return hasn't moved and it's still 10 to 12. Well, it's a much less appealing asset class. So I would argue you've had the rapid growth in this move and you've had the markets repositioning itself for the regulatory change and also the interest rate environment. But I'd argue that change is largely done now. And if anything, there's a chance it goes a little bit into reverse.
Okay, so regulatory, we've done plenty on that. Just the way that higher interest rates are hitting the market. Can you kind of explain that a bit?
Yeah, so there's two parts to this. One is the standard cyclical nature of interest rates. Obviously, as we go through cycles, which are generally in a 4 to 5 year time horizon, interest rates go up and then interest rates go down. That's a normal functioning of economy. We've seen this for millennia now. But the problem is when you're running alpha positions and a lot of leverage in a book, which is the way that is typical throughout a number of fixed income funds. The problem is, as interest rates go up, it makes it harder, increases the hurdle rate to put trades on. Because if you're able to borrow at very low rates, your universe of acceptable trades is very large. As the interest rate goes up and i.e. the borrowing cost goes up, it makes it much higher. It increases the hurdle to actually put trades on. So the universe of trades you can actually express gets smaller and smaller and smaller. Now, obviously, that will change as interest rates come down, and we're at the start of a rate cutting cycle across the globe, and it's likely the RBA is going to be cutting rates early next year. That impact will start to lessen, but it's one that's pretty much at its peak now. And there's a secondary impact as well, because obviously interest rates are cyclical, but there's a structural impact, and that's really to do with credit cost for balance sheet. So one, that the bank will charge you the interest rate, and then they'll charge you a credit cost on top of that.
Yep.
And that credit cost is increased because of the Arceus hedge fund closed down last year. Effectively, what happened is that the investment banks offered a lot of credit lines with minimal investigation or knowledge of what went on with those lines, and there was a significant hit for the investment banking community of around $10 billion. And so to recoup those losses and to make sure they don't happen again, banks are now charging a higher fee, i.e. credit spread above the financing rate. So you've got this double whammy that now you've got a higher financing rate, which makes the hurdles on your trades higher, and you've got a higher credit spread. So it's making it doubly hard to actually run alpha trades on a leveraged book. And so you've had both of these changes happen in conjunction with each other.
Okay, we're out of time, but finally, how then, given everything you've said, Wimmel, do we think about fixed income in a portfolio? It does still have some of those traditional traits, but it's a little bit more complex now.
It does. I mean, fixed income is still, my favorite asset class. It gives you the two things you want in any asset class, and certainly as part of a diversified portfolio. It gives you a positive return, and it gives you a negative correlation to equities in times of stress. But as I mentioned earlier, just relying on a buy and hold portfolio to give you those characteristics is much less efficient and effective than it was in the past. And so now you need to think about fixed income assets in a very idiosyncratic manner. I.e., do you want funds that have high leverage? Do you want to have funds that have very high credit exposures? And if you do, that's absolutely fine. But how are you blending those products, and how are you making sure you're getting your yield and your negative correlation? And those are the two key things you need out of fixed income. And you can still get them. It's still easy to get them, but you need to approach it in a different manner.
Wimmel, thank you for talking to Fear and Greed.
Thank you, Sean.
Wimmel, that was Vimal Gor, Head of Fixed Income and Multi-Asset at Ellerston Capital, which is working with Sador Capital, a great supporter of this podcast. Remember, information in this podcast is general in nature, and you should get professional advice and make sure a product is right for you before proceeding. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.